Good afternoon, everybody. My name is Sean van den Berg, and I am the Head of Client Education at PhD Online. Welcome to our webinar today. This is mainly for the novice investors, those of you just starting out on the market. Our topic is Introduction to the Share Market. Here's our agenda for today. Real basics. Obviously, we'll discuss what is the share market, the different classes of shares, and dividends and things like that. But also more importantly is for people to understand the advantages and benefits of investing in shares, obviously. But I want to focus mainly on how does trading take place, the dealing costs, and just some tips how to get started and things like that. So obviously this is an introduction. In later webinars, obviously we go into more details and things like that. Okay. This presentation is based on tutorial 1 that can be found under resources. The tutorials, so if you click on resources, you click on tutorials, and you'll find the whole list of tutorials there. So this presentation is usually based on that tutorial. So let's get started, and let's talk about the basics. What is a stock exchange? Basically, it's a forum or marketplace where shares in listed companies are bought and sold. Okay, a company is listed on the stock exchange and shares are issued therein. So you as an investor would acquire a portion of that ownership of the shares of that company, your part ownership of the company by purchasing those shares. The company itself would use the proceeds of that listing to finance expansion products or to reduce debt. And also, obviously, the investors can also sell off the shares or divest of their ownership if they decide, okay, this is not for them. And obviously, they sell the shares to other investors. So obviously, it allows investors to realize some profit should they be able to sell the shares at a higher price than what they originally paid for. So that is just a quick introduction. What is a stock exchange? You must understand, obviously, the stock exchanges all over the world. The London Stock Exchange, New York, those are some of the biggest ones. And obviously, you've got Hong Kong, Sydney, Paris, Nairobi, you name it. Here in South Africa, the stock exchange is referred to as the Johannesburg Securities Exchange, or more commonly known as the JSE. Okay. You must understand that this JSE consists of two businesses that run side by side. We've got the primary market. This is where companies come to the market to sell their shares to the public, and obviously to raise funds. That is the main objective of the JSE, capitalism at its best. But also there's a secondary market where members of the public, you and I, will be buying and selling those shares between ourselves. Okay. But once the company has sold the shares in the primary market, it derives no further direct benefit, and I say direct benefit, from trading its shares on the secondary market. Obviously, a company wants to see a share price going up higher and higher, because later on they might want to raise more capital, so if you issue less shares at a higher price. And obviously it's the whole status regarding listing on the market and things like that. It's also essential for the companies. But we need a healthy secondary market. This is where you and I will be selling those shares, buying and selling those shares to enable a primary market to be successful. So the main thing is if people realize that they can't sell the shares easily, they won't be buying into the shares. And that's one of the most important things. You want liquidity on the market. You want the shares to be tradable. So what is the role of the Johannesburg Stock Exchange or the JSE itself? It provides a regulated trading platform where buyers and sellers trade. So obviously online, PhD Online, we're online stockbrokers. You'll be using us as a platform to trade to the JSE. You can't go directly to the JSE. You trade through a stockbroker. So it's that platform that you're trading, and the JSE obviously regulates PhD. So the JSE also protects investors through its rules and regulations, and obviously guarantees all trades that are transacted through the JSE. So, and now we're talking about trading on the JSE, and we're talking about unlisted shares. Obviously, you're talking about listed shares. The JSE provides a wide choice of companies. There's about 400 companies on the market, and obviously an array of different financial products that an investor can invest in. But the main objective for the JSE is to provide an active and liquid market, as I alluded to just now with the secondary and primary markets. The trading platform is called SETS. Let's talk about some of the background. 17 years ago, that's when the JSE trading floor was closed, on the 7th of June 1996. I'm going to highlight this for you quickly. This is what the floor used to look like. You have all these boards along the top here. Those are the different sectors. and the traders used to gather below the boards and be shouting up the orders. And obviously they'll get the orders from the stockbrokers, and the stockbrokers were in the offices upstairs. So that's where we've gone to a stage now where everything's electronic. Okay, so it was replaced by an automated system. The disadvantage, obviously, with the what they call an open outcry on the floor was old mutual wants to buy 1 million shares, and you want to buy 100 shares. Who's going to get the deal first? So obviously, old mutual got the deal first. Now with the automated trading system, it's first come, first serve, and everything's transparent. So we call it the JSE Equities Trading System. That was the very first one that was launched way back in 1996. We call it the JET, and we always used to joke, so it always used to crash. And that was replaced, obviously, in 2002 by the London Stock Exchange LSE, or the Automatic Trading System. That's where we get the name, these sets from. But the main objective now is that instead of having an open outcry system, people shouting and things like that, it's more automated. We've gone from a system where the shares, we had share certificates, they were dematerialized. We went into electronic format. So we moved over to what they call straight. Straight stands for share transactions totally electronic. So obviously the whole idea of settlement is faster now. Instead of going through the whole process of little paper slips being matched up and things like that, it's much faster now. So we've gone to the advantage is obviously a rolling and contractual and again treat settlement system for all equities. And at this point in time, it takes 5 days after trade, what we call T+5. And now, just recently, they launched, we're going over to a T+3 system that's falling into global trends. So we're catching up with global markets and such. The main thing is about this new automatic trading system. It's order-driven and centralized order book. So like instead of everybody meeting in front of the boards, everything's going through one book. So buy and sell orders from investors are matched with orders from investors to sell, and that's through remote terminals, through different stockbroking firms and things like that. So that's what we call workstations, and as I say, everything's electronic now. What are the advantages? The main idea is that we have more investor protection. It's more transparent, there's more capacity. Obviously, you can imagine if you're buying and selling on the floor, little pieces of paper have to be transacted every day. Now, with electronically, and you'll see just now when we start looking at examples, these things are automatically done now on the automatic system. So we have increased capacity. Also, we have a real-time surveillance. Obviously, the story with the old mutual and you as a small prime investor, they can see that now, and you won't be jeopardized. So everything's transparent. So obviously, more security, and there's this whole audit trail, so we can see the paper trail more clearly and obviously faster. That is one of the obviously major advantages, increased investor protection. But also the other thing that came out was that stockbrokers could act as principal. A stockbroker was allowed to acquire shares and sell those shares onto their clients. Most stockbrokers did not choose that path. Remember, most stockbrokers are what they call agents. They are middlemen between a buyer and a seller. We match a buyer and a seller on the market. But the broker can also act as principal. If he does act as principal, obviously he has to declare that and things like that. Okay, but as I say, most brokerage houses decide not to go that way. What are shares? Okay, as I mentioned just now, obviously for companies to expand, they need additional capital. This is to finance the operations, finance the projects, and they raise this necessary capital by selling shares to the public or to the investors as such. Each share represents a part ownership of that company. So it entitles you as a shareholder to vote on important corporate matters at the AGM, but also to receive the dividends if dividends are declared and paid. Okay, so the investors who purchase those shares are termed shareholders. Shareholders may receive dividends if and when the board of directors declare the dividend. Okay, it's only paid out of profits. As long as they have sufficient profits and so the board declares it, those profits will be returned to the shareholders. Another name for shares can also be called equities. We share equally in the profits and we share equally in the losses. Also, Americans like to call them stocks, also referred to as securities, etc. Okay, but there's a direct relationship with the number of shares you own and your ownership of the company. Okay, and the more shares you own, obviously the greater percentage or greater amount of company you own. Okay, so that's also important to see who are the main shareholders of the company. If the directors of the company are major shareholders in their own company, that's good, because they have a vested interest to make sure that the company is successful. Okay. So there are different classes of shares. We talk about ordinary shares, preference shares, and we talk about debentures. Most of the shares that trade on the stock market are ordinary shares, and those are what we focus on mainly. So ordinary shareholders, okay, if you're an ordinary shareholder, you have voting power and you have ultimate control of the company. Okay. The disadvantage, obviously, is that you can only get access to the dividends when they are declared, and you can only get it out of profits. So and that's also only when it's declared by the directors of the board of the company. Okay, depending on how many shares you got, that's how many dividends you'll be getting. Okay, so you got 500 shares, you're getting the equivalent of 500 dividends, whatever the amount is. Okay, another advantage is if the company goes into liquidation, the company winds up its operations, you only receive the residual claim on its assets after all the assets have been sold and everything, and the creditors have been paid off. What's left behind is what you're entitled to. Okay. Ordinary shareholders have no specific maturity date. We'll talk about preference shares now, no fixed income and things like that. However, they're also subject to a lot of price volatility, and you as an ordinary shareholder assume much greater risk than, for example, a preference shareholder. But obviously for that you get rewarded. Okay, with a lot of other things. We'll talk about it just now. But as I mentioned, the majority of the shares listed on the JSE are ordinary shares. Companies obviously issue ordinary shares most of the time when they first start out, but later on, as they expand their businesses, they might issue other classes of shares. And those other classes of shares, for example, would be preference shares or debentures. Preference shares, the word comes through where you get first option or you have a preference to the dividends. That's the major difference between an ordinary shareholder and a preference shareholder. They have first option when it comes to dividends, number one, and number two is that they have a prior claim to any repayment of capital on the winding up. So obviously if the company goes into liquidation, they have to be paid out first before you as an ordinary shareholder. That preference dividend, by the way, is guaranteed as a certain percentage of the dividends, okay, which makes the dividend more regular and more stable than the ordinary share. So who would get involved in these kind of shares? It would be the investor looking for a hybrid debt and equity investment exposure, or looking to a medium risk return scenario. Obviously, debt instruments have much lower risk, but also slightly higher risk than debt, but lower than ordinary shares. So someone's looking for some income. You'll see some of these preference shares will have 6% behind it and that kind of stuff. You get a whole lot of different preference shares: cumulative, convertible, redeemable, participating, fixed or variable rate preference shares. The main thing is with these things that you as a preference shareholder have the disadvantage that you cannot vote at the AGM. That's where the ordinary shareholder has the advantage, and obviously has a bigger say and control over the market. So there's pros and cons with these two kinds of shares as such. The third class of shares, what we call debentures, they're fixed interest-bearing securities. They can be viewed mostly as a loan contract. The company promises to pay a fixed interest at regular intervals and to repay the capital on a future date or future dates as such. So you can compare it to a fixed bank deposits. They pay interest, but not dividends. Okay, so debentures again can be classified according to the security, the term, in other words, the duration, and the yield. Again, there's also various classes of debentures: fixed, variable, secured, unsecured, guaranteed, redeemable, convertible, participating income, and things like that. It sounds a lot. Just remember, we concentrate on ordinary shares. Okay, that's what I want to highlight for you. We trade many ordinary shares on the market. What are dividends? Where a bank deposit will attract interest, shares attract dividends. Now remember, dividends can only be paid out of the company's profits, not from its assets or anything like that. So it's distributed as a cash dividend or as a scrip dividend. Those are the two options that a company has. Obviously, a cash dividend is you receive a check, or you get a bank transfer into your account. Scrip dividends, on the other hand, this is where you get additional shares or new shares instead of cash. The company will do this, obviously, to conserve cash flow. The disadvantage, obviously, it dilutes shareholding. Okay, dilutes the earnings ultimately because there's more shares in the issue, and those kind of things can affect the ratings. The amount of dividend is not fixed. Okay, It depends on the discretion of the directors. Okay, they decide what portion of profits should be retained, held back into the company for future expansion of the business, and what portion should be distributed to investors. Obviously, it's a fine line. Most of the time, it's about a third. We pay out a third, and we hold back 2/3 for future expansion. Some companies, depending on how mature they are, they pay out more dividends because they have enough cash flow from their operations to keep them going. New companies sometimes don't pay out any dividends. I remember about 5-6 years ago, Microsoft never paid out any dividends. They believed that they can do more of the money than you can, so they reinvested the dividends. But saying that, dividends are declared every 6 months. Obviously, the first period is what they call the interim dividend. This is where we anticipate the profits for the year, and we pay out a certain amount. And in the final dividend, this is where we actually based it on actual results. So those are the two dividends you get: the interim and the final dividend. Combined together is what they call the total dividend. We'll come back to taxation just now, but obviously dividends now are taxable. We pay 50% tax on that dividend, but this obviously before it gets into our hands, the tax is taken off already. Apart from dividends, obviously the major advantage is we're getting growth in your capital investment. So people look at a low dividend yield of 3% and they don't really get excited, and they rather prefer a capital growth of 50%. But it's tying the two together. Capital growth generally holds more appeal, but also obviously there are some companies that, as I mentioned just now, believe that let's reinvest all the money back into the business, especially for research and development and expansion and things like that. Some proponents of this view, or critics of dividends per se, suggest that some companies are too eager to pay out all their dividends. And this is just an indication that the management is running out of ideas. But studies have shown that companies that pay out dividends have higher earnings growth. Obviously, the two together, you want capital growth and income, and growth in that income. So those are the kind of shares you want to be focusing on. So as long as the company can fund its future expansion out of its dividend, it's fine. You want to see a company paying out all the dividends all the time. Okay, what about the future? Okay, when it comes to dividends, there are 5 days to remember. First of all, obviously declaration date, and obviously this is when the day of the SENS announcement. Right at the bottom of the SENS announcement on the financials, you'll be able to read regarding the dividend. So this is when the dividend is actually announced. So it includes the dividend size, the ex-div date, the payment date, and things like that. It's also referred to as the announcement date. Obviously, once authorized, it's now declared. Okay, now the company, obviously, remember it was cash, now it becomes liability. It has to be paid out now. It was an asset, now it becomes a liability because the company has to pay it out. That will be how it will be reflected on the company's balance sheet as such. The most important date as such, well, one of the important dates is LDT, last day to trade. It's usually a Friday. Okay, this is the last day that you as a shareholder are eligible to get the dividend. Okay, what they call cum dividend, with dividend, or including the dividend. You need to own those shares on that date to be eligible for those shares. If you sell those shares after that, obviously before that date, you lose your right to that dividend. Okay, so after that date, it becomes ex-dividend. And this is the second most important date. This is usually the Monday after LDT. Okay, so the Friday would be the LDT, the weekend, and then Monday is the ex-div date. Now this date's also important because the share price will drop by the amount of dividends, roughly about the amount of dividend being paid out. Now people say, whoa, this is bad news and things like that, but the market adjusts very quickly. Okay, because remember, you as the shareholder that don't own the shares have to wait another 6 months to get those dividends. So obviously supply and demand will equal it out and the price will increase again. Okay, so LDT and ex-div date, those are the two most important days to look at. The record date is usually the following Friday. Okay, this is for the company mainly to determine who's the shareholders and who's entitled to receive a dividend. So it just ensures that the dividend payment is getting to the right people. And then the Monday after that will be the payment date. It's usually a 2 week after that, but you'll see that the dividends be in your account or credited, as I say, by the stockbroking firm. Here's Sassel, which is an example, a practical example. I got this from the SENS announcement. Declaration date was Monday. LDT was a Friday. Okay, so it's nearly a month later. That's on Friday, the 5th of April. Monday, the share went ex-dividend, and the record date was a Friday, and then the Monday afterwards was the dividend payment date. And that's generally the pattern for most companies. I saw this morning that Cargo is paying its dividend out on the 18th of June. You think, no, well, that's a Tuesday, why not the Monday? Because Monday is a public holiday. Okay, June the 16th, and then obviously Monday's carried over. Okay, but it's usually on a Monday the dividend gets paid out. Okay, so that is a quick introduction to the share market and things like that. But let's talk more about the advantages. Why must you invest in shares as a shareholder? A lot of people are under the impression, they have this myth that you need a lot of money to get started. I always joke, you need $1 million, to make $1 million, you start with $2 million. Now, I'm joking, you don't need a lot of money. Okay, but obviously you have to take into consideration the costs. 1,000 Rand, our minimum cost is 98 Rand per trade. The shares move up 9.8% to break even. Save a bit more, 10,000 Rand. But more important, spread the risk. With 2,500 Rand in 4 different shares, your cost drops down to about 3% rather. So you don't need a lot of money to get started. And there's a lot of other mechanisms like the exchange traded funds and ways to get started. It's also quick and easy to simple or to liquidate, to sell out. Saying that it's better to trade in free dealing shares that are trading quite often. If you look at a graph and flat lines, it looks like buildings. Those are shares you want to stay away from. Those are not tradable stocks. So that most of the time you can get out of the share very quickly. The nice thing about shares also, you're entitled to the profits of the company without physically having to get involved in the day-to-day running of the business. So those of you that always have the dream of starting your own business, look at the stock market as a view of having access to profits without having to get involved day-to-day. Okay, and obviously sharing the profits. But saying that also, you're not responsible for any losses. The only risk you're taking is the money you're investing in the company. So I'll go buy 5,000 Rands worth of Sasol. If Sasol goes into liquidation, I'm going to lose my 5,000 Rand. I don't have to top up anything. Okay, so those are some of the advantages, obviously, as an equity investor. The risk as such that you expose yourself can be limited, obviously, with a sound investment approach. We'll talk about risk management just now and things like that, but also just selecting good quality stocks, doing your homework and things like that. So it's just basic knowledge about the market. But you do much better than any endowment policy as such. Another advantage, obviously, of shares on a daily basis, I can see the exact value straight away at any time. I can go to the newspaper, I can go to the internet, and I can see the value of my investment. So those are some of the advantages as such. Obviously, with the whole change to automated trading, there's a lot of other things that come into play. The JSE has strict membership requirements for PSU to be a member of the JSE. We have to adhere to certain legislation and JSE rules. We also have to have a certain amount of capital available. The JSE itself has a surveillance team that monitors all the transactions on the market. And obviously there's a lot of strict procedures that we have to have regarding managing people's accounts. Now, PSG Consult, for example, would have stockbrokers that manage its clients' portfolios, and obviously there'd be a lot of regulations around that, what we call discretionary accounts. The central order book, obviously, the main idea is, as I mentioned before, you get more transparency, more security, and bottom line, you're going to enhance investor protection. There are two funds as such to protect the investor. Number one, the JSE Guarantee Fund. That's if a stockbroking firm defaults. Obviously, there's recourse. And also, the stockbroking firm itself has a form of insurance called Fidelity Insurance Company. This is if an employee of a stockbroking firm acts fraudulently or steals clients' money. You're also protected that way. So there's also some of the benefits regarding the JSE. People always think it's a gamble. It's a casino. No, there's a lot of things in place to protect you. Okay. So you also have many rights as a shareholder. You have the right to receive the dividends when dividends are declared. You have the right to vote, especially an ordinary shareholder, at all the AGMs and shareholder meetings. And obviously, you have the right to equal treatment at all times, regardless of whether you are controlling or minority shareholder. So, for example, Bidvest is on an acquisition trail. Say, for example, they acquire Adcock, whatever price they pay for Adcock, the small shareholders have to be offered the same price. So you're entitled to equal treatment. You're entitled to competence, integrity, and honesty. Okay, it's, from all directors. It doesn't say it has to be like that, but you're entitled to it. And obviously, you're also entitled to be kept informed. That's why it's important to keep track of sense announcements, create a watch list of the shares that you want to follow, and that's where you'll be able to check information on your company. So how does trading take place? Okay, the share price is the price at which a particular share will be bought and sold. So that's determined by supply and demand. Okay, if there's more buyers than sellers, prices will rise. In other words, the shares are on demand. If there are more sellers than buyers, prices will fall. There's oversupply of shares, and obviously as the price comes down, it becomes easier to buy. If the company is very profitable, the share of that company will become more valuable because people will think it's an investment. Okay. But also you must understand there's a lot of other factors, economic and political factors that can influence the share price. Bottom line, you can put it all together. We talk about market sentiment. How does the market feel about certain factors, the future prospects and things like that? Okay. But now the traders of the company obviously deals through the centralized order book by entering the buy and sell orders into this trading workstation. We mentioned just now called sets. Okay. Gives you a summarized display of all the aggregate orders on one page. Okay. So if the dealer has not ordered entered the trade into the book, you can't partake of the trading. But I quickly just explain to you how it looks like. There's two parts to the book. There's a left side and the right side. Obviously, you got on the left-hand side, you've got the buyers or the bids. Okay, on the left-hand side, we've got the sellers or the offers, and it's ranked by price. Okay, and we go on the buyers, we go from the highest price to the lowest price. And the sellers, we go from the lowest price to the highest price. And the idea is that the orders have to be matched. So you as an online client, we're able to see exactly the same thing as the trader will be seeing, okay, via your online trading account, and you can also enter and manage your own orders yourselves, okay. So that's the first thing, how the book is set up. Secondly, it's organized along the lines of price and priority. So it's price first, best price. So 99 cents is the highest buyer, and 101 cents is the lowest seller, okay. But now this, for example, 99 cents is also based on time. That's made up of two orders. They're both 3,000 Rand or 3,000 shares. Those are the number of shares to bid. Okay, but it's also time stamped. The first order came in at 9:35. Other one came in half an hour later. So let's explain how the process would work. Orders are matched straight away. So let's say someone comes into the market, a seller comes into the market and is willing to sell 5,000 shares at 99 cents. So obviously he's the lowest seller. He jumps a queue now, and that's how the market will look now. Now the idea is that we want to match. We're exactly the same price now. We want to match. So now that it gets matched, and three things have happened now. One member has purchased 3,000 shares at 99 cents. Another has purchased 2,000 shares at 99 cents and remains a buyer at 99 cents. And the third member has sold 5,000 shares. And this can happen very, very quickly, and this happens all the time, continuous. So it's dynamic. It happens all the time. As long as we have a willing buyer and a willing seller, the price, it happens automatically. Okay. So that is how quickly the trades get traded. As I say, it's automatically traded. Remember, it's time and price stamped. Price first and then time. Let's talk about costs. Brokerage refers to the fee or commission that goes to the broker who buys and sells shares on behalf. It's based on a sliding scale. At PSG Online, we have a sliding scale, minimum of 98 Rand per trade. It's a sliding scale from 0.9 to 0.5. The bigger the transaction, the cheaper it becomes. So let's look at some practical examples. Okay. Obviously, you've got brokerage and also got a lot of other mandatory costs like VAT, securities transfer tax. Obviously, that's payable on brokerage, settlement costs, and the protection levy. Securities transfer tax is a government levy. It's charged 0.25% of the value of the transaction. Remember, it's only on the purchase, not on the sale. Okay, so it's just on purchase, 0.25% of the value, and then we have what they call settlement costs there's a large big percentage here, but a minimum of 10.92 and a maximum of 54.59. So this is all part of the dematerialized process, settlement costs, it goes to straight. And we have this thing called insider protection levy or investor protection levy, very small percentage that goes to the surveillance department of the JSE, obviously for the systems and things like that. It's calculated on the value of the transaction. So let's look at an example. Investor wants to buy 1,000 shares at 15 Rand a share. So the value of the transaction is 15,000 Rand. My brokerage is 0.9% of that. So it works out 135 Rand. My VAT on that transaction is 18 Rand 90. And then my securities transfer tax is 0.25% of the value. So my total cost is 191 Rand. So that is a percentage of my 15,000, 1.28%. So as I say, the bigger the transaction, the cheaper it becomes. Remember, 1,000 Rand, the shares has to move up 9.8% to break even alone. So try and always make your transactions at least 8,000 Rand plus to make it worthwhile. So on the selling side, we get exactly the opposite scenario. We want to sell 5,000 shares at 25 Rand a share. Your brokerage fees and things like that, you can see the cost. Main thing here, there's no securities transfer tax on selling. Okay. Again, you can see the cost. The bigger the transaction, the cheaper it becomes. Just to show you the sliding scale up to 25,000, 0.9. From 25 to 100,000, 0.85%. And then from 100,000 to the remainder, which is 25,000, 0.75%. Remember, the system automatically calculates this for you. And on our website, there is a brokerage calculator that can also help you calculate this before you put in a transaction. Another thing you have to look at, you have to decide for yourself, am I an investor or trader, or you want to be both? There are situations to be both. Obviously, there's implications for both in the sense that two different accounts and there's certain costs involved. But as an investor, your goal is passive management. Your view is 3 years plus. We talk about a buy and hold strategy. You're going to buy into quality, undervalued shares, and you're going to build a balanced portfolio. So your goal is capital growth, but also dividend income and growth in that income. If I'm an investor, I buy once and I don't sell, I have low brokerage costs. If I buy the share and I hold it for these 3 years, and after 3 years decide to sell, the capital gains tax applies. If I sell it before 3 years, the income tax applies. So that's why it's important to separate your strategies. Obviously, it depends on your risk profile and things like that. Some of you might not be a trader, don't want to be a trader, and you're perfectly happy being an investor. So just because, you want to highlight the differences between them. The active trader obviously needs more time. Active management, I've just done the opposite here. This is your view is less than 3 years. You get three different kinds of traders. Position trading is the active trader. So you're holding a position up to a few years, but you're trading the cycles as such. Swing trading is obviously a bit shorter term, lasts from 2 days up to a month, and then jobbing is the day trader. The guy gets in at 9 o'clock and sells at 11 o'clock, buys again at 12 and sells at 3, that kind of stuff. So your goal is still capital growth, but now obviously you can start using derivatives also, things like single stock futures and CFDs. You can buy low and sell high. I buy at 5 Rand to sell at 10 Rand, I make a 5 Rand profit. With derivatives, I can sell at 10 Rand and buy back at 5 Rand. I'm still making my 5 Rand there. But now the disadvantage, obviously, a trader, and this you have to take into consideration, you'll be trading more often, so you've got higher brokerage costs. So obviously, you need to take into consideration when you take out your profits, make sure that you cover your costs. If I'm buying and selling, receiver sees that as income, and obviously you'll be taxed at the high. It depends on your income tax bracket. Up to 40% on your profit gains. Okay. Just want to show you quickly some of the tax implications. We talk about that capital gains. Let's say, for example, after 3 years you decide to sell the share. And let's say, for example, you made 100,000 Rand capital gain. There's a thing called exemption. Okay, the first 30,000 Rand of profit is exempted from tax. So in this situation now, we have a 70,000 Rand taxable gain. They have an inclusion rate. It works on 33% at the moment. So let's work on the maximum. So let's say, for example, you're on a 40% tax rate. 33% of that 40% tax rate, the maximum you'll be paying is 13.3% tax on your 70,000 Rand gain. So in this situation, 9,324 Rand will be paid in tax. That's on capital gains. So that's just the things you have to take into consideration. Remember, if you're an investor, your view should be buy and hold long term. So, if your view is shorter than that, obviously capital gains comes into consideration. There's a whole tutorial on tax. Please read up on it. I mentioned just now about dividends. Any dividends you might have is now taxable. Yes, cargoes. I took us from this morning's SENS announcement. They talk about a gross, obviously before tax, of a gross dividend of 20 cents. And then if you're not eligible for dividend tax, remember dividend tax is 15%, the stockbroking firm will subtract the 3 cents rather, off that 20 cents. So you'll have a net dividend of 17% declared. Okay, that's what you'll receive. So just be aware that obviously dividends are, the tax is taken off before you receive it. That will be done by your stockbroking firm already. Okay. By the way, I forgot to mention that I know some of you might have a lot of questions. I'll be answering the questions at the end of this presentation. And also that I'll be sending out this presentation to all of you that are on this webinar, and I'll also be sending the recording, if I can get it right this time, to all of you to download. Okay, so I'll answer a lot of the questions just now. Let me just go through this presentation near the end, and we can tackle them more. So what are the risks involved in the market? Obviously, there's more risks involved than putting your money in the banks. If you want to be rewarded for that risk, but the policies, risk and return should rise together. So imagine your return is easy. You get a capital gain, the difference between you bought it and what you sell it at, plus your dividend. You add those two together, and that is expressed as a percentage of the price you paid, and then annualized. So let's take example, you bought a share at 1 Rand, you sold it 6 months later at 15 Rand or 59 cents, and you took a 50 cents dividend in the middle. Your total return will be 550 cents or 55% for the 6 months. Annualized times 2 is 110% rate return. So that's the easy part, measuring your return. As I say, the two principles governing the return on investments is the greater the risk, the greater the return expected. The longer the money is tied up, the greater the return expected. So those are two principles we must take into consideration. The return side is easy. The risk side is much harder to do. And that's where most people leave it up to the gut feel. So let's talk about risk. There are certain kinds of risks out there. We talk about a market risk. This is if the whole market falls. When you talk about a stock market crash, okay. You also get what they call investment-specific risk. This is where a specific share will fall based on some event or circumstance specific to that company. Okay, so those are the two main risks you get. You also have what you call interest rate risk. That's if the company falls when interest rates rises. That could be a company that's too highly geared, too much borrowings and such. You also have a default risk. This is when the company becomes insolvent or bankrupt, the shares suspended, and the listing's terminated. Okay, so that's also a problem there. That's why you want to stay away from these penny stocks. The shares are trading at 1 cent. They were at 5 Rand, now they're 1 cent. So those are the shares that are very, very close to being suspended and obviously being delisted. And you also have inflation risk. Now, there's no investment that is entirely risk-free. Even a AAA government bond, which is the safest form of investment, is affected by inflation. So, when it comes to your investment, you obviously need to outperform inflation, and obviously you take into consideration your costs. So those are the two percentages combined together that you need to work on to make your investment profitable. Okay, so let me just go back there. You can imagine a scale. On the one side of the scale, you've got government bonds are very, very safe, and you've got equities in the middle, and the other side of the scale is your speculative, unquoted shares and your derivative products, which are very, very risky. So that's how you got to look at your risk profile. Where would you see yourself on that millennium? What product would you go for? So how do you manage risks? The old saying, don't put all your eggs in one basket. If the basket falls, all your eggs are broken. So you want to spread your eggs around, spread your shares around. So in a variety of different sectors, from different companies and different investment products. This is one way to choose your investments. But bottom line, always do your homework. Be it on the company itself, through regular reading of financial literature, attending courses, webinars like this here, and asking people questions, especially stockbrokers, asking you advice, what they think of the shares and things like that. Be committed to your investment objectives. Again, this is where your financial planner comes in handy. Talk to the guy and together commit to a plan. Determine your investment period. And remember, as an investor, your horizon should be 3 years plus. And just be patient. Okay, if your share does not perform as it needs to, maybe you have to look at your strategy, review your strategy. Okay, determine your risk profile. You can be conservative, you can be a prudent investor, you can be aggressive, and so on. But you must be comfortable with your strategy. Remember, you invest with money you can't afford to lose. This must not be the rent money or the school fees money or the food money. This is the disposable income after all your needs have been taken care of. Okay. Bottom line, you still be prepared to take the risk of losing all your money. If you lose all your money, it's not the end of the day. So that's the kind of attitude you must have. But obviously, you want to minimize that risk. So we talk about market risk and investment-specific risk. Market risk, we saw back in 1998, the Asian crisis, the Asian contagion, and more recently, the subprime crisis, even in Europe now. All these things cause markets to fall heavily. So you can't really diversify that away. Diversify is putting your eggs in different baskets, but you can use the stop loss strategy. If the share drops 10%, your stop loss kicks in, and you sell your shares. That's what you use in that scenario. Investment-specific risk, this is, as I say, factors that are specific to a company. I used the example of Rainbow Chicken. A few years ago, Rainbow Chicken was affected by Newcastle disease. They had to slaughter all their chickens and obviously affected the production and obviously affected the earnings at the end of the day. This can be eliminated or reduced by a well-diversified portfolio. Spread your shares between 3 and 5 different sectors and between 12 and 15 different shares. Okay, so diversification, as I say, you want to buy into a number of different shares with uncorrelated returns. So, for example, maybe buy some shares into chemical, beverage, and transport sectors. Then you want to put all your eggs in gold or all your eggs in platinum shares. So you're going to have between 12 and 15 shares to diversify your risk. But obviously, you never remove all the risk. You can own all the shares in the market. If the market falls, your whole portfolio is cleared out. That's why you want to put your eggs in different baskets. So that's one way of doing it, is diversification. The other way is using hedging. And this is where maybe derivatives like single stock futures and CFDs come in. It's a form of insurance. Okay, so it's diversification, hedging, and stop loss. Those are the 3 ways to manage your risk. Okay, so how do you know which shares to buy? Obviously, by doing your homework and things like that, you can make more educated decisions. But obviously, attending webinars and things like this, you learn. Bottom line, you need to ask 3 questions. What shares must I buy? When must I buy? And when must I sell? If you can answer those 3 questions, you'll be making money in the market. Okay, so that is broken further into what we call fundamental analysis and technical analysis. Now, you as a novice investor or novice trader have to start learning more about fundamental and technical analysis, the 2 approaches to the market. Fundamental analysis is concerned primarily with analyzing the future profitability of the company. So answer that question, what share must I buy? So we look at a lot of factors, obviously the financial statements of the company, but a lot of other economic variables, political factors, labor relations, etc. Technical analysis looks at the charts now and start looking at price and volume patterns. And the idea that we're using those now to help us predict future patterns and future trends. So that answers the question when to buy and when to sell. Okay. So what must you do from here? Choosing your first shares, I suggest always choose quality. We talk about blue chip shares. These are companies been around for a long time. These are stable, well-established, well-managed companies. Obviously, these are companies that are hedged against inflation. They're growing slowly. They're more mature. So we're also paying out dividends. Most of the time, they're well-known, more reputable companies out there, the APSAs and the Anglo-Americans and things like that. But buying into these blue chip shares obviously will substantially reduce your risk. So these are better quality stocks in the market. When we talk about the blue chip shares, you can say the top 40 stocks and the next 60 companies, what they call the mid caps. We talk about speculative shares. These are the shares that haven't been around for so long, less than 5 years. They haven't got so much of a track record. The prices are very volatile. The prices can go through the roof and also fall through the floor literally overnight. So you have this high potential for return, but also a high degree of loss. This is where a lot of private investors like to get involved in these little penny stocks. Just be careful of these shares. There are a lot of small cap stocks. The shares are not in the top 100, which are good quality stocks, but do your homework. Okay, don't just go buy a share based on rumors. Go do your homework. Go try and find the companies that are showing consistent growth and are growing slowly and paying out dividends. Those are the kind of companies you want to go on. So yes, you can get on the ground floor with these small companies, but do your homework. Okay. Always choose shares that are tradable, highly liquid. The problem with a lot of liquid stocks is that once you convert them to cash, now I've got cash, now I can go overseas or buy a car and things like that. Remember, as I said, you just not be committed to your investment plans. This is forever savings. So hold a definite view of the long-term investment approach. So don't just sell, buy, sell, and move the shares into cash. Maybe have a separate account for trading and for income. But your investment portfolio is for long-term. It's forever savings. Try and discipline yourself not to withdraw money out of that account. Okay. And then obviously, thirdly, to help you choose your shares, always choose shares with technical analysis. Okay. Once I've identified what shares to buy from a fundamental point of view, don't just go buy shares on following the crowd. The best time to buy shares when everyone else is selling. So the share price is falling, but how do you know when the best time to buy? Because when you use technical analysis. There's various tools you use in technical analysis to help you get as close to the bottom of the cycle as possible. So that'll help you to choose your shares. And obviously, this is very quickly to get you started. And later webinars, we'll go into more detail how to do this, how to choose your shares, different approaches to the market. So things you should never do, never buy shares in tips. Always ask yourself a question, would I have bought the share without this tip? If the answer is yes, then maybe just go research a bit further. Just be careful. Where there's a tip, there's a tap. Someone's trying to dump these stocks. Always justify your purchases. Every time I buy a share, write down the reasons for buying a share. If I only got one reason, I've got a tip from John, you haven't done enough homework. So the more reasons you have, with hindsight, you can learn from this. And that's also a big learning tool, is writing it down. Never be greedy. And that's one of the biggest dangers in the stock market, is emotions. So don't let your emotions rule. So it's easy to get excited when you're making money, and you feel despondent and depressed when you're losing money. So be aware of your emotions. Don't let it rule. So never be greedy, but also, never marry your shares. Some people get attached to the winning shares. They hold their NASPAS shares or their Bidvest through highs and lows, even though the shares become very expensive from a valuation point of view. But also, don't forget the shares that you sold off. They might have been losers. You might have got in the wrong time, so don't just ignore them. So don't shun your losers. And then lastly, you should never buy shares on borrowed money. Now, I'm saying this from an equity point of view, and this is specifically for the novice investor. You don't want to go take money out of your bond to go buy shares. If the stock market crashes, then you're supposed to pay the capital back. So when it comes to equity, it comes to derivatives and things like that, yes, it's a form of borrowing money, but obviously it's more for the advanced trader and things like that. It's gearing and leverage. It's managing its risk is more important. So this is more for the novice investor. Save up the money and start with what you've got. Don't go borrow more money, because obviously if things go against you, you're in trouble. And obviously that's when emotions really start. If you sort of be greedy, you have fear, and that's also a big enemy in the market. Okay, so what do you do next? Obviously your first step is to educate yourself. Go through the online tutorials, attend some more webinars. These are the webinars coming up in the next few weeks. The point and figure charts, there's investment strategies, there's more on derivatives coming up, currency futures, and more technical analysis. So these are the webinars for the next 3 months. And we'll have some up soon until the end of the year. Those of you that haven't got an account with us yet, go register on the PHG Online website, go register for a free trial, see what we have got to offer. We have a simulator, and the simulator there is you have 100,000 Rand fictitious money you can buy and sell with. So now you can learn how to place trades, and also buying the real shares under real trading conditions risk-free. So try us out. That's what the whole idea about the simulator. You have access to research tools and everything for 30 days. Thereafter, open up a trading account with us. Do the whole FICA thing. It's not going to cost you anything. It's going to cost you 40 Rand a month in admin fees. You don't have to start trading straight away. But then as you gain more confidence, that's how you get started. Okay. What tools do you need? You need some charting software, especially if you're become a trader. We have a software program called Web Professional. The software is for free. provided you subscribe to our download service. The download service is only R169 per month. Once we receive the order, the CD gets couriered to you. It takes about 2 to 4 days. Okay, so those are some of the things to get started. Attend our traders forum meetings. This is where we actually get face-to-face and we talk about the market in general. So this is more for the intermediate investor or trader. So we talk about some trade ideas and some investment ideas. I've got one coming up in Joburg in 2 weeks' time. Tuesday the 28th of May. I'm in Pretoria at the end of June. Back in Joburg again in July. And I'm in Cape Town end of August. Okay. Just remember things are limited. Seating is limited, so please book early. Okay. Quick summary before we hit the questions. The main objective I want you to get out today is that there's 2 things as an investor or as a trader. One thing is you want to maximize your returns. The other side of the coin, you want to minimize your risk. How do I maximize my returns? You do your homework. Obviously, this is where the research comes in, the fundamentals and the technicals. I like to combine the 2 together, fundamental analysis and technical analysis together, what I call rational analysis. The more informed I am about a company, the better decisions I'll be making, and hopefully more money. But my goal there is to find shares that will give me the capital growth plus the dividend income. Obviously, this is all part of your strategy, or you a value investor or growth investor. So bottom line, you want to focus on quality stocks and shares that are offering value. So that's looking at maximize my returns. Other side of the coin, obviously, you must remember the risk. You're going to manage that risk. So we talk about diversification, especially with an equity portfolio, between 15 and 12 shares in your portfolio, and across 3 to 5 different sectors. And then obviously you want to use a stop loss, especially when it comes to trading, or you want to hedge yourself with derivatives. So those are 2 main points I want to get across with this webinar today. So in conclusion, remember, I hope I've laid down a foundation for you. I've explained some basic concepts for you. The share selection process is very, very basic at this stage. Gave you a very quick overview. Obviously, as you gain more knowledge with regards to fundamental and technical analysis, you're adding your own criteria. And obviously, over time, you'll be able to hone your abilities even further. Okay. So from my side, good luck and happy trading. Here is my email address, and there's my phone number. Any questions you guys have, if I don't answer the question here on the webinar, I'll be able to answer it a bit later coming through. So let's see the first question here. Is this material in this is from Johan, multimedia to be downloaded? Yes, hopefully I'll have it soon. Now, audio connection. Just make sure you should have your mic and speakers on. Craig, sorry, what you want to say? Every second word is distorted. Don't know about that. I did test it beforehand. It came out through. Okay. Okay, there's a question from Marius. What's the significance of a dividend record date? As I say, that's mainly for the company, obviously to know who's eligible for the dividend. LDT actually determines who gets or not dividends paid on my trading date. Also, there's 2 different questions here. LDT is an important one. That's where you have to have the dividends. So you own the shares on that Friday. On the Monday, you can sell the shares. You'll still be getting the dividends. Obviously, the Monday is what we call ex-div date. So whoever owns the shares and buys the shares on that day will not get a dividend. So those are 2 most important ones. 2 dividends get paid into my trading account. Yes. That is from Stephanos. Yes. And that looks like all the questions, guys. I don't see any other questions. So if there was a problem with audio, my sincere apologies. So I did test it before we got started, and hopefully the recording came through also. But I'll be sending out this presentation to all of you that are on this webinar. And from my side, yeah, okay, there we go. Chris, thanks a lot. No problems on our side. So yeah, it looks like selected. Stella, very audible. Could not hear a word. Okay, so there's quite a few people. Some more questions coming here from Stephanos. Are the price of preference shares the same as ordinary shares? No, slightly. Sometimes they might trade a slightly bit higher. Remember, they're not very tradable, so they're not exactly the same. Jock says also his audio is fine on his side. Let me just maximize this quickly out here. Skulk, will I be emailing it? Yes, I'll be emailing the link to the presentation. Yeah, so I've got mixed reactions regarding the audio. Some got it, some did not get it. Will there be a tax benefit in receiving income from shares in a business instead of a personal account, as with other sources of income? Who's asking that question? Vickers, I'm not 100% sure of your question. Will there be a tax benefit receiving income from shares in a business as an entity? No, there's no real advantage. Obviously, dividends have been taxed already, and if you decided to take your profits, obviously capital gains applies differently to companies than to individuals. Same with the trust and things like that. I'm not 100% sure, but speak to your accountant. I know company tax is 29%, so it might be lower than your personal income tax, but rather clear that up with your accountant. I'm not 100% sure on that side. Great. Thanks. Okay, guys, from our side, thanks a lot, and I hope you enjoyed it, and we'll talk again. Enjoy the rest of your day. Thanks. Bye.